I have with me Josh Siegel, Managing Partner and CEO of StoneCastle Partners. We're going to talk about capital management. We're going to talk about sort of how to raise capital, what investors want to see from a bank who's looking to raise capital, different forms of capital available, and access capital for public and privates. But before we really launched into it, I wanted Josh to take just a minute or two, for those of you, if you don't know StoneCastle, who StoneCastle is, to give sort of your background so they know where it's coming from.
Sure. Well, StoneCastle is a firm dedicated to investing in community banks. That's all we do. We're about $7 billion of assets, about 54 people. And for the last 11 years, we have invested in capital into about 431 different community banks in 47 states. We have a deposit business as well, where we put about, today, just under $6 billion of deposits in about another 500 and change banks. So we have a presence in about 850 banks around the country. But that's all we do. We'll talk a bit today about different types of capital, how we think about capital, but that's the short of us.
So as an investor in many community banks, I think a sort of, maybe this is too high level because it could generate a really long answer, but as an investor in many banks, what essentially do you want to see when you start looking at a bank? What's really what you want to see from a bank to consider an investment in that bank?
That's a great question. So I have an answer, because it's going to be an answer that's relevant to me, but I'll also share sort of the thought that you have to think about what's in the mind of an investor, because my answer may not be the same as other investors. So we're a bit unique in that we take a very long view. And the question that you have to ask as a bank when you're raising capital is, what is the mentality or what is the rationale in the mind of your investor? And what's always been difficult in private equity investing, I'm going to do the famous quotes for that, because there is no exact private equity, right? A private equity could be a wealthy person in your town, it could be a fund, it could be a pension or foundation. And all of these entities can have very different views, but one consistent theme usually is the rate of return, right? Most private investors are looking for a pretty high rate of return, right? High teens, 20s. If it's a fund, probably 25 to 30% annual rate of return, not total. They're also usually looking at a timeline, right? Because when you think about private equity, it's usually, and it's oversimplified, but it's true, it's investing at a price for the stock, and the way you make money is the stock has to appreciate, and then you have to exit it. If you don't exit it, it's like art on the wall. It doesn't have much value, right? So there has to be a monetization. And the difficulty with many investors is that the timing of that investor may not coincide with the timing of the board or the management team on when they want to get out. And that can lead to some very difficult board meetings. So for StoneCastle, we're a bit different. We have always funded ourselves with investors who want a very long view. So we've made, as I said, about 431 investments over the last 15 years in total since we started investing as individuals. We've exited one. Mm-hmm. So we're a very long investor. So we tend to look for stability, because we tend to do more preferred stock than we do common stock, so we can be very patient. We can wait 5, 10, 15, 20 years. There is no particular exit. As StoneCastle, we're a public company, so we have permanent capital. So it makes us a bit unique. So we're looking for kind of a high single-digit return, 8, 9%, not a crazy rate of return. We can wait a very long time. We don't need a bank that has a view of, when's the IPO happening, or when is the merger occurring. We're happy in a nice, stable bank that doesn't have any plans for any of those strategic deals. They're just running a very nice balance sheet. So we're a bit different, but the mentality is important to understand what the alignment is between the investor and the bank.
Know who's giving you the money, because they're going to have different expectations.
Absolutely.
You said, you guys are fine doing preferred. Often everybody's talking about common. So when any community bank is looking to raise, they're often focused on common. I guess sort of the question would be, can community banks raise preferred, and is that good capital in the mind of the regulatory community?
That's a great question. Can they raise preferred? It's not easy. We spent 3 years trying to get StoneCastle Financial launched. There are a few other investors in the country on the institutional side who will make preferred stock investments, but there aren't many. But the second part of your question, I think, is the more relevant. Is it good capital? And it's funny, we had C.K. Lee up here from Commerce Street earlier, and he and I recently were asked to speak at the Dallas Fed, just down the street. And it was every 2-year grouping of all of the application staff for the Fed system across the country. And I asked the question of the audience. We flipped it around, and I said, please raise your hand, examiners, if you think that non-cum perpetual preferred is good capital. They all raised their hand. Nobody had an objection. And I told about the same size room, I said, would you be surprised if I told you that if I asked a room of bankers the same question, that probably less than half would raise their hand? And they gave that puppy dog look. And I said, well, that's an issue, right? They said, yes. Why do they think that? And I said, well, probably because you, as a regulatory body, have assumed they didn't have access to non-cum perpetual preferred. So the discussion is always common, right? You need to raise more common. But when you ask any regulator, and you can test it, you don't have to actually be wanting to raise at this moment, call up your field examiner and say, if we were to raise non-cum perpetual preferred, is that good tier 1 capital? And they would say, yeah, of course. Didn't know you had access to it. But yes, it is a valid form of capital, and very often it's cheaper than common, where when you're raising common, and this is probably worth talking about on this panel, because there's a misconception.
Right.
When you raise common, you're selling away some of the future of that bank. So if you sold 10% of the bank's stock in a raise, private or public, you're selling away the compounded growth in tangible book itself, but then also the price to book expansion. Mm-hmm. So very often, we heard it today on some of the panels, you'll hear the comment, well, I can raise funding at 1.9 or 2 times book. So of course I'm going to do common. Well, that's only half the question though, right? Because if the real expectation is that we're going to go from, in the next 2 years, from 2 times book to 2.8 times book, well, what's the IRR of that? The bank is growing at 8 or 9%, that's compounding for a few years, and the price to book expansion, you really sold away, I can do the math, it's about a 15% annual rate of return. So raising preferred at 8 or 9, it's accretive.
Right, and we heard earlier, everybody's cost of capital is around 12 or something. That's pretty easy math to sort of see the difference there.
It is. The cost of capital, that's probably a relevant thing, is many bankers, we know many and have seen many, they're excellent bankers. They're not all the best sort of strategic investment bankers, because it's a different skill to think about cost of capital for yourself, right? Rather than being a very good marketing person, underwriting, credit, workout, right? It's a different skill set. So when you think about cost of capital, the 2 ways to think about it, not even in the context of M&A or something of that nature, is to say there's a relative cost and an absolute cost, right? So the absolute cost is, okay, we're going to grow our bank by 100 million of assets. So to fund that, rough math, I need $10 million of equity, I need $90 million of deposits. Today, the average cost of deposit funding is in the nation about 60 basis points. So 90%, 60 basis points is 54 basis points. And if you were to raise preferred stock at 9%, for that little 10%, that's 90 bips. So that's a blended cost of about 150 basis points to put money out at 5.10, for loans. There's your 350, 360 NIM. That's not dilutive.
It's a good trade, yeah.
It's a good trade.
That works.
Right, and and that's just a flat. So as the bank grows, that's not sharing in any of the benefit or growth. Mm-hmm. Then you have to think of the the relative measure, right? So take someone like First Republic, Jim Herbert's bank, right? $42 billion, nice bank, high net worth focus. I think he's actually even BBB rated. And he did a couple $100 million non-cum perpetual preferred, I think it was 7%. Right? I think it's off the SNL site, 7% rate. So then you'd say, okay, if I'm a nice, healthy, $800 million bank, how much cheaper do I need to be for the investor taking less liquidity in that investment? I have less diversity. I'm a little more concentrated on a market, which is both good and bad. So you have to say on a relative, is 8 or 8.5, is that reasonable relative to other market comps? And that's sometimes hard. And on that same note, I'm sorry if I'm droning on about it, but I think another thing that bankers have to understand when they think about cost of capital is very often I'll talk to a bank CEO and they'll say, well, we can do a local raise. We could raise local preferred at 6.5%. And I would say, I know you can, of course, right? Your local investor should be your best investor because in sort of classic economics 101, they have other utility they get from being the investor in your bank, right? It's the prestige of being maybe on the board or being involved in the community bank. But eventually, if you ask yourself as a bank, well, I could raise some equity at 6%. Can I raise 3 million of that? Can I raise 6 million? Can I raise 10? Can I raise 15? Like, where does it end? It's not limitless, right? There aren't unlimited local dollars. So the question is, what's the next
We found that out during the crisis, for sure.
Oh, definitely not during the crisis, but even today, right? It's where's that next dollar coming from, and then what's the cost of that? And what does that mean in terms of enabling my growth?
So how do you do that? Do you you're setting up a scenario where you're saying, you plan out. You don't plan just for next year or the year after that or whatever. So what do you do? I mean, I think you would go to a point where you say you don't wait till when you need to raise to do it. How early does that conversation start? If you decide I want preferred because it makes sense. So how do you go about starting that process, and when does it begin?
Well, it's funny. The same adage of the time to get a loan is when you don't need one. It's the same thing. It doesn't change because it's the other way around, and it's the bank looking for funding. A bank should be lining up sources of capital, even if it has the faintest view that it might find a reason for capital raising. And that capital raising could be for, in no particular order, an acquisition, funding organic growth faster than retained earnings, or share repurchase. That's one big issue that's going to be coming up in community banks, which doesn't require an egg timer to start. So you have, 6,700 and change banks left in the United States. About 6,200 of them are private. Also about 6,200 are less than $1 billion in assets. And the average age of that bank is 72 years old. The average age of the board of directors is also about 72 years old. And the average age of the management team is over 60. So one of the things, we hear this often on the M&A, what's driving M&A, yes, regulatory costs are one of the factors, but I find, in my experience, age. Age is one of the big issues that you can't cheat, right? Death and taxes. And there's very little succession planning at the executive level, but there's even less succession planning at the board and shareholder level. So share repurchase is going to be an ever increasing issue as people want to retire, want to monetize. Older shareholders have kids going to college, they need some cash for that, and very often these banks can't provide that liquidity. So finding pockets of investors where it's not raising 10 million, but raising 1 million, raising $500,000, raising 2 million. You need to have those discussions early so that when the moment comes up, when that one shareholder, God forbid, passes away and the trust says, please just get us out, that you could get it out at a discount to where a fair market value might be just because they need an out right now. I was talking to a company that's one of the largest transfer agents for community banks. They said every year, about 2 to 4% of the shareholder count of every community bank, they do about 600 community banks, comes up for disposal due to death, just estate planning. He has nowhere to go. It takes, the gentleman who runs this firm, takes him on average 3 years to unload those shares.
Wow.
So having an ability, having that discussion now, whoever it is, whether it's us or someone else, line up a few investors who will get through the diligence process, get you approved, and when you're ready, then you can do something. But to wait until the moment comes up where, hey, I've been waiting a long time, and Herb, who runs the bank next door, he just decided, he's going to sell, and I figured when he's ready to sell, I'll buy his bank. What happens if he just calls you out of the blue tomorrow, and you don't have capital, and then he's going to hire Commerce Street or KBW or someone to run a process? You may lose it. You were waiting 8 years for him to sell.
And so you go and you have exploratory conversations. So let's say they come to you or someone else like you. What do they need to present then? Do they need to present a growth plan? What else do they need to present? Obviously a growth plan. No, here, invest in my bank. We're not going to do anything with it if we need it. But what else do you need to see at that point if you're not saying, please give us $10 million? What do you share with them?
Well, it's funny, you say growth plan. If you're growing, I'd like to see a growth plan. If you're not growing, I don't need to see it. It depends on what your model is, right? People will use the term country club bank in a pejorative way. I don't read it that way, right? There are many banks that are there for the purpose of providing liquidity of commerce in their footprint. And they do this almost as a social function that's required for those towns to exist and live. For us, as a long-term investor, I'm perfectly fine with it. I don't need a growth plan. I'd like to know how you handle credit. I'd like to understand how you're connected to your local community. I'd like to understand how you define yourself to your customers. So the process is we have the bank fill out a due diligence questionnaire so we can learn some things about the bank that you can't get out of an FR1 ankle report or SNL, right? There's just a lot of the non-public data. Mm-hmm. We want to meet with management. We'll come on site. We'll see the branches. We'll go through some loan files. Want to go through the loan tape, deposit tape, securities portfolio. But the whole approach for us is we're trying to understand management and how they think and how they align themselves to their local market. But also then understand the local market. So you and I, we've been looking at banks for a good chunk of our career, and if we both looked at a bank and said, wow, this is just a stellar management team. And we look at the balance sheet, lots of capital, lots of liquidity, all right? great asset quality. But then we both uncover the fact that most of the customers of this bank work at a single auto parts manufacturing plant. Maybe not, right? So you can't just look at the balance sheet management and say, great. A bank is nothing other than a reflection of the risk in its market. The real estate risk, the consumer risk, and the business risk. That is a community bank, and you can't avoid that. You can't get out of the way. That is what you are. The question then is, are you connected to the market strong enough that the good opportunities come to you? And do you structure your balance sheet in a manner that's appropriate to the risk you take? That's overly simplified. That's what we're trying to find out.
And what sort of red flags, let's say that they have bought into this idea that they're going to go have the exploratory conversation, what sort of red flags jump at you? I think I remember hearing you say one point, you ask everybody what their top 3 credits are, and if they don't know the answer of it, you're gone.
Pretty
or something like that. I mean, I'm paraphrasing.
No,
but
it's not too far. I mean, there are things that you learn, kind of the litmus test issues, right? So when we meet with the management team, that is one of the things we'll ask is, tell me about your top 3 or 5 non-performing loans. And if they have to, hold on for a sec, no, that's not a good sign, right? I mean, if you're running a $20 billion bank, I expect that. If you're running a $500 million bank, you should know. You should know off the top of your head. You should have a command of your single biggest problems that you're dealing with and how you're dealing with it and what the background of the company or the person is and the assets. And I'll tell you, 80% of the time, the CEOs, CFOs know. They don't have to go shuffling. They're in command of their book. So that's important. But really the things that we're looking for in terms of flags would be strategy drift. So if you've seen a bank operate in a certain manner for a long period of time and then it wakes up one day and says, I think leasing is good, and it doesn't have any experience in leasing and it didn't hire any leasing people, I might question why you're doing that. Are you chasing returns? Or is there actually a change in your market? Right? Or have you hired a staff because you want to pursue a market? That's valid.
David Brooks talked about that earlier, not being sort of flash in the pan on new ideas, the dress up. That was a huge red flag for him with sellers.
Right. But that's not to say that you shouldn't pursue other opportunities. It just means you shouldn't pursue it recklessly. Right? Significant changes in capital ratios or liquidity, right? Very rapid growth. So it seems common sense. A rapid growing bank is difficult. Well, roll back 7 years, no one thought that. But if you imagine if a bank was $500 million in assets and in 2 years it went to $1 billion, how did you put on the credit so quickly? But more importantly, how did you put on the credit in the face of other competition? So did you bend on credit or did you bend on pricing?
Price, right.
Because it's a zero-sum game in a market. If the local economy that a bank is facing is growing at 6% per annum, how do you grow it 25% per annum?
And if you are, you're taking some risk.
You're taking some risk. I mean, on the margin, maybe it's that you hired some good loan officers away. That helps for a little. You can't do that year after year after year. Very rare, right? So if you're doing it organically, you have to start wondering how are you winning away all this business from other banks? So that's a flag. Doesn't mean it's a non-start. It's a flag. To your point of, what are our flags?
What do you want to see from a deposit base right now? This is going back sort of the last panel. Everybody was talking about modeling for deposit runoff. As an investor, you want higher margins, right? I mean, maybe you said you don't care as much about actually really, really growing unless you have a real growth plan. But a lot of banks are sitting on excess liquidity. What would you like to see a bank do who's in the classic scenario whose loan deposit ratio has gone from 90 to 70, 90 being pre-crisis, 70 now? I mean, how would you like them to treat the liability side of the balance sheet? Do you want to see them running stress models, knowing that they're doing that? And do you want to see them giving away any of that deposit business or rebalancing it?
That's a great question as well. Well, they should be running stress testing on their own anyway, whether regulators ask or not. Maybe this is a long answer to it, but it's all relevant, right? Deposit growth and deposit quality matters more if you have loan growth. If you don't have loan opportunities that are good, why attract deposits, right? A natural ALCO committee should be then lowering its rates to naturally shed. Natural attrition if it wants to attract, right? ALCO, I used to be a commercial banker, right? Well, we'd raise our rates and that's how we'll pull in deposits. So the deposit franchise, in my view, is still the greatest value in the organization because other entities, whether it's a real estate investment trust or a business development company or a CLO or any non-bank, their cost of funding is significantly higher. The reason that a bank can make a loan work at 5% and a hedge fund says, I would never lend at 5, right? Because you're borrowing at 5. Right? You can't lend at 5. A bank's borrowing at 0.6. So the better access you have to that deposit base and the lower cost you have to that deposit base, the stickiness of those customers, that's the value. But that flips to the other side, which is every bank is, by its nature, a fixed income investor. And banks are unique, and I would love to talk about the soapbox of it because people don't think about this. Everything's different about a bank from almost any other investor. Right? A bank is all in the risk avoidance business. There's no such thing as a better loan that I've ever seen. There's a bad loan, but there's no such thing as a better loan, right? It's asymmetric risk.
You don't pay double, right?
You don't pay double, right? You put 100% of your principal at risk to make 5% a year. It's all downside. So it's all about risk management. If you're a Fidelity Magellan Fund or Carlyle, right, your job is to pick a winner. It's an entirely different mentality, and you can go pick equities or commodities or emerging markets. You can do anything. Community Bank does 4.5-year duration, fixed income, in a footprint. And so there are only 4 variables that I know of that affect the future performance of a bank's portfolio. The probability a loan goes bad, how much you lose if a loan does go bad, interest rates, and prepayments. That's it. Those are the 4 variables that predict the future. So if a bank, forgetting the term stress test, if you're not actually modeling out what in your economy, your local market, can change the probability of loans going bad and how much I lose, which are the 2 most important of those 4, you're driving blind. So I definitely want to see a management team that is always thinking about that and has a pulse of what's driving those factors. Is it unemployment rate? Is it median home price to median income? Capitalization rates on commercial real estate? Average age, average education level? Why does average age care, right? Because older people's income doesn't go up. Younger people's income go up faster. So you get a lot of view of trends and directionally where market goes. So those are the things that they have to be thinking about, because that whole deposit question is contingent on what your loan opportunities are and to match the 2.
Do you get the sense that folks are doing that?
No,
Not
enough.
Not enough.
Not enough.
What would drive them to them? We're hearing that regulators are asking them to model runoff right now. I've heard all different kinds of numbers. I haven't really got anybody to figure out. Maybe it depends by region, but more that they want to see it.
Yes.
So I mean, will it be more focused there that will really prompt people to do it, or will it be a move in rates that will actually get people to do it?
That's a good question. Now, I spend a lot of time, as you know, teaching regulators. Mm-hmm. That's where I don't get paid for it, which is nice, but I do spend a lot of time doing it. One of the concerns they have, and it's not wrongly founded, is that if you look at community banks, not just community banks, regional banks, even money centers are going more and more negatively gapped. Right? They're shortening the liabilities and not shortening the assets as much. And that has gone noticed. So there is an increased scrutiny right now on this issue of interest rate sensitivity, and it's not wrong. It's not as dire as it was during the SNL crisis, but it's concerning. So what makes the banks move to respond? It may be once it occurs. I hope that's not the case. I hope the industry sort of wakes up to looking at that issue of the liability composition. Do I start mixing in term deposits? Because rates historically, when you look back in time, and in fact, we probably have a slide on that we could touch on. Do you mind?
Yeah, go for it.
Pretty relevant to that question. I'm just going to bounce around here, guys. There we go. I love this one. So this is since 1954. This is looking at all the big rate shifts. And you can see that just 3 that I pointed out, I mean, these weren't small moves in a short period of time. The first one, right, 711 basis points in 18 months. Ouch. All right, then you had toward the Volcker Part 1 years, because he's back. Right? Volcker was 12.5% in 36 months. Ouch, that would hurt.
Yes.
Right, and then was the last one, right? Another 300 basis points in 15 months. So usually when I just pick 3, when they move a lot. When it moves, who knows, right? That's a crystal ball. But we do look, and you asked the question before, what are some of the red flags we look at? It's yield chasing on the securities portfolio as well. I forgot to mention that. Mm-hmm. When we see, and usually rate is the biggest tip off. If you see security portfolio yields, high 2s, low 3s, they're taking duration risk. Usually it's not credit, it's duration. You see someone in the mid-high 1s, they're probably taking too little, right? Usually 220 is about middle of the road to be matched duration. So it's all around these issues of stepping back and just saying, okay, what is my business? I need to stay focused on my business. I need to spend less time on all of these regulatory matters. And it's not that you have the luxury. I mean, don't get me wrong, I understand when the examiner comes in, you have to do it. But having taught examiners for 6 years now, it's the lack of communication, the lack of transparency. Not that anyone's willfully hiding. It's that there are many CFOs, treasurers, and CEOs who haven't eloquently explained why they made a decision, why they're running the balance sheet the way they are. Most examiners, if you get them comfortable, it's just a human in a seat, you get them comfortable that you understand why you're making these decisions, that it wasn't just I woke up crazy as a nut job and went, yeehaw. I mean, there's a plan. And when you can communicate the plan, it gives that examiner a lot of comfort that they don't have to worry that you're going to fail. And to the rate issue as well, another thing that I'm not seeing enough of is very often the discussion around hedging, right, or my ALCO mix is very focused on what I can do with my assets and my liabilities, hence ALCO. But a lot of smaller banks don't explore things like a very simple interest rate cap. It's not even a FAS 133 derivative, it's just an asset. And you don't have to hedge the liability here. I mean, all the banks in the room are averaging kind of mid threes, low fours net interest margin. What a regulator is worried about is the net interest margin inverting, right? Not compressing a little.
Right.
Right? It's just nature. You can see that the slide, right? I mean, you will have periods of compression. The question is, can you stop out that NIM compression at, say, a short-term NIM at 1.5% versus 3.5% until your assets reprice to come back in line with liabilities? This is a question of, it's like a yo-yo, right? It just expands. You can go back to the 1930s. The net interest margins were still 3.5 to 4.5. Doesn't matter where rates are. It's whether rates move first or second that will change the NIM in what timeline, right? It's that mismatch between your asset and liability mix. So if all banks were floating and floating, no one would really care, but they're not. So
right.
It's the question of, can you handle those periods of compression where your liability cost goes up and your assets haven't yet repriced? And if you were to buy an out-of-the-money interest rate caps, meaning that if LIBOR or Fed funds or whatever you want the index to be, if it goes over 3.5, then for every dollar after that, I'm going to receive income. Right? That gives a regulator comfort without costing too much in terms of current net interest margin. You're just buying an asset. It just has a mark you can get from the Bank of New York or whomever.
As you said, I mean, they don't care about double-digit ROEs. They care about negative ROEs. I mean, are you going to have money to keep the shop open? And are you going to be profitable? I
mean, sadly, I would think regulators are a bit too insensitive to that delicate balance between the fact that you do need regulation for this industry to exist. I mean, it's not a gamble. In fact, just to give a sense, in the 1920s, there were 30,000 banks in America, one per 2,200 people. That's more than like corner drugstores in terms of ratio. And 10,000 of them failed in about 7 years. 10,000 of them. And that brought about the advent of the FDIC, right? And since then, the average failure rate per year is about 38 basis points. In fact, the worst failure rate for the entire banking industry was 2010, 2%. That's it, just 2%. Not very big. It scares people when banks fail, but it's not actually a very volatile market. So the regulators don't seem to have a whole lot of sensitivity to the fact that for the industry to continue to grow, investors have to earn a fair rate of return. That doesn't mean the 20% private equity, but it needs to be kind of that 8, 9, 10% ROE, right? There's still a lot of banks not at that, and part of that is too much capital. So it's a balance between what's needed for safety, but what's needed to keep that liquidity of commerce coming in. And I've heard even, again, CK had mentioned this in the past, I've heard him talk about it as another former regulator, is that it seems that too many regulators are too insensitive to the fact that if the ROE gets too low, that perpetuates a drought of capital, which could lead to all of these subsequent issues.
You could cease to have access to capital because of that, because you need to actually offer some return.
Right.
Anybody from the audience now? I can pick up on that very easily, but I will pick up on that. So assuming you said too many banks have too much capital, and that's part of the problem. Let's say you're an investor in that. What do you want them to do with that excess capital? I mean, I guess it depends on the shop, but do you want them to return that capital to you if they are not in a market? If acquisitions aren't a line of business and they're not in a market that's actually growing, do you want them to return it to you? Do you want them to wait? What do you want to see them do?
Well, it's a good question. For the examples that when I'm a common equity investor, then you do have to think about cost of capital. If there's really no rational short-term need for that capital, no pending acquisitions you're thinking about, no organic growth opportunities that warrant excess, then you probably should consider returning some of it if you're comfortable that you could raise it again, which very often you can. I mean, the old adage in like the restaurant business, sometimes you see a really great restaurant close at its peak and you say, why would they close it? Because their investors did well, they had such a good reputation, the next restaurant they want to open, they can open like that. when a restaurateur lets the thing come down to rats on the floor, they're not going to open another one, right? So very often, showing your investors that we're sensitive to our capital issues, that we're too much capital, so I'll give it back to you, but I'm hoping that when the time comes, I can give you a call. More often than not, I've seen that works. If I'm a preferred stock investor, I don't really mind if they're sitting on excess if the rest of their common shareholders are fine, right?
Right.
So as long as they're paying me the 7, 8, 9% preferred rate of return, I'll be patient. I don't mind. So it really depends, again, this alignment of interest of what the equity investor has in mind, what their goals are, and what the bank is trying to achieve. It's really a question of
Let's say your
opportunity.
average bank with your average investor, and we don't have private equity in mind, but maybe they
Right.
have some sort of preferred. What is the optimal sort of level of capital? Maybe common in that point. I mean, how much? I mean, the minimums aren't what you need to be at.
No, of course
that's
not.
that because if you're managing at the minimum, you probably got a problem.
Exactly.
Or you're going to hear about it a lot. So what is it? I mean, is it 200 basis points in excess of the minimum? I mean, does it depend on the market? Does it depend on the risk?
Yes and yes. And it's not an evasive answer. Most regulators, when you talk to them at the field regulator level, they would say, no, the right level, it depends on what you tell me your business is. If you're predominantly a consumer lender, you're doing unsecured short-term loans, as I'm making up numbers, 40% of your balance sheet, I need to see more capital and more liquidity, right? If you're telling me that all you do, you're an old thrift, you do 1 to 4 family prime conforming mortgages, ARMs and some 15-year fixed rate or 30-year, I don't mind if you run with 7.5% or 7% core equity, because I don't expect to see a lot of losses or a lot of risk. So it's going to be very dependent, but I would say the floor is probably in that realm, kind of for core tangible, kind of 7.5, 8, and if you're a higher risk, it might have to be 10 or 11. It just depends. Just the same way, the regulations, even under Basel III, would say that in theory, up to 50% of your Tier 1 capital can be in the form of a non-cum perpetual preferred. I would never advise a bank to get anywhere near the rule. You'll be in trouble. But 15%, 20% of your total, maybe even 25 or 30, most regulators think that's just fine with them, because both common and non-cum perp both have the same loss absorption, right? Because there's no compounding of that missed payment. Whether you own common or preferred, well, let me flip it. If you're a bank that's issued common or non-cum perp, if things don't go well, you don't have to pay either. And the regulators can stop the payments and nothing accrues. So it has the same loss absorption. It's just the choice of common shares in the future of the bank. The preferred doesn't. It just earns a fixed rate of return.
You were saying, it depends on the business. You think the regulatory community understands that or is willing to understand that? I was having conversations with folks here about how the industry gets painted with a broad brush on a sense that a bank that is in Metro Atlanta, not to pick on one market, but a market that experienced pretty significant stress, gets treated as the same as one in Nebraska. Because many of the directives come from Washington, and they're not necessarily at the local level. Do you think they understand, hey, we have this business model, and so we don't need to operate with the level of capital the guy down the street who's doing something different?
Again, the answer depends on your bank. If you're an OCC or former OTS, I think it's a harder problem because it is more centrally governed, and it is, this is, friends at the OCC will be upset, but it is somewhat a one-size-fits-all. They would say no, but the reality is that is somewhat what gets through. But if you're a state fed or state non-fed, no, you can actually have much more impact with your examiners and your staff, or their staff, onto what our business is, why we're good at it, why we have risk under control, how we approach it. So, and again, and even there, it's state by state. And in some cases, of large states like California, it's district by district. I mean, they're humans, it's people. I mean, you can meet one person just doesn't like you. Same rules, just doesn't like you. Guess what? You're not going to be able to amend your plan.
No matter what the scenario is, I mean, I think you would advise everybody to attempt to have that conversation and come armed with details. I don't know if armed is the right word to make it sound contentious, but with specific details on why you are approaching something and why you don't think that it's a higher risk or a lower risk or something of that nature.
It's a sales pitch. Mm-hmm. I mean, I learned this when I was a kid, right? Everything is selling. You can be an artist, you're selling. You can be a doctor, you're selling. Every business requires sales. So when you talk to your examiner, you have to sell them as to why this is the right decision. and not come in as an exploratory, well, we're thinking and I'm not really sure. No, that's not going to build anybody's confidence. So you want to come in with confidence, but more importantly, just like we started the discussion about when's the right time to raise capital, when do you start the process? Now, right? Even if you don't need it tomorrow or next year. I mean, every bank, and we have a mix of banks and other folks in this room, but call your chief examiner tomorrow for a cup of coffee. Really. I mean, just call them up and say, I would love to find some time in your calendar to get together. And that examiner is going to say, why? What's the topic? And you're like, nothing. I'd love to chat. They're humans. And there's a communication gap.
And you let them know your plans, let them know
just want to get to know
which
you.
way to go.
Right. It's not that they're going to bend the rules if something were to happen, but I can tell you firsthand, when your examiners have a personal relationship with you, they'll give you the benefit of the doubt if things go bad, versus if you've always been obstinate or MIA, never really had a relationship, and then you have a hiccup in the bank, you're not going to get any break.
And should you do that once a quarter?
That's a little too much. I'd say at least once a year, maybe twice a year. I mean, it shouldn't be a big burden for you to go spend. I mean, if you think about relationships that the bank has, customers, deposits, loans, well, the regulator, next to your board is probably your most important counterparty. Mm-hmm. I would hope you meet them at least twice a year for half an hour.
I remember someone at our M&A conference a few years ago saying that they have a standing meeting where they present a wish list of things they want, and then they go over their biggest concerns and tell them how they're going to address them. And so when the exam comes around, they've already sort of aired it. They get out in front of the story, so to speak.
No, you have to do that, and sadly, because the budgets are very thin especially at the state level, the staff can turn. Right? That's probably one of the challenges I hear the most is I spent all this time building a relationship with he or she, and he or she is gone. I have to start again. Yes, you do. There's no way around that.
They're not going away.
Right? One of the regulators not going away, but that individual.
Well, right, that's
so you have to build a relationship with the next one.
Sure.
And so it is a constant process. And we are in the most regulated industry that I know of in America. There is no more regulated industry. And sometimes I'm shocked that I even see really well-performing banks, but they don't put enough time into the regulatory relationships other than when they need something. Mm-hmm. And that's the wrong time to ask for anything, is when you need it. The time to ask is when you don't need it.
Mm. Any questions? We got a few minutes left. Yes? How do you factor in an S Corp to that discussion?
Well, an S Corp, the question was, how do you factor in an S Corp in terms of capital, I assume, right? With an S Corp, you have less options, of course. You can't do preferred stock, usually. Right? Very few have made provisions. But you can do Tier 2 sub-debt at a holding company and downstream. It's double leverage, so you have to do it in moderation. There are some things you can explore. It's a bit of the new technology that people are thinking about. But you can do different classes of common. You can do A common, B common. And if you talk to your examiners, in fact, I had a meeting with the Treasury about a year ago, and it was actually the Assistant Secretary of the Treasury for Financial Institutions had thrown that idea out to me. Because have you looked at different classes of common for some of the pass-through banks? So there are some options, but this is really a question that you have to work with your auditor and your counsel as to what your charter allows for, but there are some options. It's less so, right? But the benefit is you don't get double tax, so it's sort of a give and take. But some of the other things we didn't talk about in the few minutes we have is, at least from my vantage point, why I'm still excited as an investor about the space itself. I mean, I think there's some trends that it's very hard when you're doing the day-to-day this close to your business to have perspective. I mean, just quickly, some things that come to mind. One, I think that technology that used to be a barrier to small banks will ultimately be a savior. Because if we go back to the 1970s, all the largest banks, they had this thing called an ATM, which was basically a fax machine with a little something that spits out dollars, right? And it was very expensive, and only the biggest banks could have it until they didn't, right? And it permeated down to every bank in the country. And then we had internet banking, right? And that was a big thing because you had to build one of these things. And then that became cheap enough for almost all small banks to have something. And then in the last 6-7 years, we had mobile banking, and now you have about half the banks in the country with some type of mobile bank. So if you just sort of keep going to this logical conclusion, and as you know, technology isn't a linear thing, it's exponential. So it gets exponentially cheaper or it gets better much faster. I would forecast within 18 to 24 months, every little bank can afford basically the same level of technology that B of A, PNC, Fifth, or any of the regional or money centers can offer a client. Every small bank will, whether it's mobile remote deposit capture or the Mint, mint.com personal financial planning. All of these things will be available for very, very little cost. So then, what advantage does B of A have? No one from B of A here, right? What advantage does B of A have at this point? Nothing. People often ask me as an investor, like, why do you invest in these little community banks? How do they survive? Right? It's not that they can offer cheaper loans, not that they can offer better technology. Well, because it's customer service. It's a real relationship. Know your customer means something. And there's a whole trend of local coming back that I find exciting that maybe people are missing, but during the crisis, do you remember like insurance companies would have commercials?
They can play into the farm to table movement with food.
But it's true. Farm to table, craft beers, artisanal foods, right? There's this whole local movement coming back in America. People want to come back to their communities and their roots. Because when I was growing up, right, things from abroad were cool. They were foreign. Fashion from Paris, food from the Orient, right? Well, now there's Amazon. So anybody can get anything anywhere in the world. But you can't get the cheese made at that local dairy farm because you can only get it here. And community banks are the embodiment of this local, and I'm starting to see that trend. That gets me really excited because it's an opportunity for the banks to have no more disadvantage to the large banks. I mean, heck, even Elizabeth Warren came out pro-community bank, and even the FDIC this morning.
Right.
Yay, community banks serve
and
a
people
purpose.
like to say they know they got their product from somebody that they know.
Exactly.
That's starting to come back.
Starting
So
to
why
come
would
out.
it be different with a financial
Why
product?
would you bank with some no-name bank that's not even from here versus we've been here for 62 years? So I like that trend.
And I'm guessing you would advocate everybody in this room to try to
Tap
lean
into
on
that.
Tap into that.
It costs nothing to add that to your marketing plan.
Right. We got just a few more minutes. Anything? Yes, right in the back.
What's your level of involvement as an investor?
Great question. So you promised me no feedback. So as an investor, you would probably call us a passive, permanent minority investor. We don't do troubled banks. It takes too long to fix a broken bank, and frankly, more often than not, it doesn't work out well. So we only invest in healthy banks, right? Not the healthiest, not the fastest, sexy ones, just healthy banks. So as long as your team is doing their job, you may never hear from us, or maybe hear from us once or twice every couple of years. If you want our involvement or help, we're not an advisor, we're not an investment bank, we're an investor. So we always help the banks we're involved with if they want. They want to bounce a question off us about technology or best practices, or I'm going to have a meeting with my examiner. Call and we'll just happily chat with you, but we're not sitting on a board. We never take board seats. We'll ask usually for board rights or board observer rights in case things don't go well. We can listen and hear what's going on, but we don't want to micromanage. That's what management's the first thing in our process, as I mentioned, management, market, balance sheet. So we're trusting management. So we're typically quite passive, but it's not because we're just passive. It's because we have you. We have someone who's running the place, who has run the place, who's from the market. We're not going to do anything better.
And you invested in the first place because you like something.
That's exactly it.
Anything else? Well, with the last minute, I would ask this question. We heard this morning about sort of haves and have-nots, and have-nots being 2/3 of the industry. What would you advocate to those guys? What should they do if you're not earning your cost of capital? Maybe it depends on the institution, but broadly speaking, if you're not earning your cost of capital, what do you do? Do you get a plan to get there more profitable? Should you consider partnering? Do you have to consider a way to get there?
No, you don't have to. It depends, again, on your shareholder base. Mm-hmm. If you're locally owned or you're family owned and you're fine with the ROE you're earning, why do you have to do anything? You don't, right?
If you're the investor, right.
If you're the investor,
right.
Why do you, right? Or if it's a closely held institution, you may not. But if your model is that you do want to continue to grow, not necessarily rapidly, but you want a future, you may want to exit at some point, whether it's 3 years, 10 years, or 20 years. You do have to ask yourself this very hard question, and it's not a popular question. That is, can we generate a cost of capital going forward that's worth remaining independent? And you have to think about the fact that if I'm part of an organization that is growing faster and they are more likely to have a liquidity event. Right? Putting your shares in the hands of someone else isn't necessarily, as a shareholder, the worst thing. I mean, most of us don't own our own companies, right? Most of us in our retirement portfolio, we own stock or bonds in other companies. So you do it anyway. It just feels more personal when it's, your bank. But the reality is you have to make this decision is, do I stay invested in my bank? Do we put the effort in? And it's effort. It's effort, right? I mean, there are a lot of boards I meet with, and they call it exhaustion. They just say, so now I got to go see some new technology platform. I got to go hire people again. They're tired. And if you feel like you're the one who's tired and you can't get back under your toes into a fighting stance, you have to have that real hard chat of maybe we need to sell, right? And not for the last nickel of price, but a fair price. On the other hand, if you really can look yourself in the mirror and say, yeah, I'm excited again. There's an opportunity here. We've got a lot of tired competitors and we can acquire them, or we could acquire branches, or then you just have to figure out how you're going to get there. Stay to that goal, stay focused. And more often than not, with still 6,700 players in this industry and 90% of them profitable, earning an average 9, I think a lot of them are getting there just fine.
Well, I think that's a great place to close. Thank you very much, Josh, for a spirited discussion.
My pleasure.